Hello, and welcome to another edition of Inside the Portfolio with Hobart Wealth. I'm Jacob Woodrum, Director of Investment Strategy. Joining me today is David Weinstein, Portfolio Manager of the Dynamic Growth Select Strategy, as well as Chris Hobart, Founder and CEO of Hobart Wealth. So thank you guys for being here today.
Good to be here. Happy to get invited. Good to see you, David, as well. We're excited to have you share some great insights with our clients, specifically since last time. There's been some good moves in the portfolio, so I'm excited.
Yeah, it'll be a good conversation. I know when we last spoke, David, with you, the portfolio was working through a challenging period of market volatility and some relative underperformance. But since then, we've seen a meaningful rebound. And so, we thought it would be valuable, I think, to revisit the strategy, discuss what's changed over the past quarter, and more importantly, though, what has not. And, our goal today, it's not simply just to review performance. I think what we envision for this is to say, well, let's help us better understand the investment process behind the strategy, the opportunities, David, that you and the team are seeing today, and, why we continue to believe that this strategy can play a really important role within a diversified portfolio. So, David, thanks again for joining us, and really want to begin with what's changed since the last conversation. And when we last met and had the last call, we discussed how periods of, we'll call it market dislocation, different market environments often create these opportunities for a concentrated strategy like yours. So what I'd love for you to speak to, at least here to kick us off, is, over the last several months, we've seen a meaningful rebound in the portfolio, but looking back over the last quarter, what's changed and what has stayed the same?
Yeah, well, some good things have changed and some things have stayed the same, but on net, I think it's been more positive. So when we talked last quarter, we were coming off a 5-month period, probably beginning in around Halloween of 2025, where we saw widespread weakness in a lot of technology stocks in different industries, from enterprise software to even cloud computing to digital advertising, and even some of the top semiconductor names like NVIDIA and Broadcom hadn't done as well. Well, that's where we had a lot of our portfolio positioned over that 5-month period. So it was a challenging period for us, and certainly in the first quarter, performance was a little weaker, down almost 18%. But what we said back then, and what we tried to emphasize, was that, hey, we think we have category-leading franchise companies across these different industry groups or sectors or categories, whatever you might call them. They're growing very quickly. I think we had a weighted average growth rate of over 25% revenue growth, right? That's not just earnings growth being faster than that, because they're all generally expanding their margins over that period. When you have 25% growth in your portfolio, it's only so long that the market can ignore that sort of growth, I think. So that's really, so we started to see that change a little bit in the second quarter, and probably two different areas, I would say. So one is we continue to maintain and even increase our investments in enterprise software. And we had two companies in particular that really did exceptionally well this quarter. One was Datadog, which was our top performer in the second quarter, up over 100%. That was a new addition in February. Datadog's a little bit interesting, and I won't get too much into the business of what they do, but it's interesting because Datadog was one of those names that we saw selling off in that 5-month period that I talked about. We added it in February, sometime in mid-February. I think our average price was around $120. We grew the position, even as it kind of went below 120, and I think it eventually dropped out around $100 a share. Well, Datadog's a company that we know well, and we've owned it in the past. And we were excited to get it at, basically a 45% discount or so from its high, about 6 months ago. So that's one example, right, of sort of getting something new into the portfolio in a space that we know well, enterprise software. Now, Snowflake's a little bit different. Snowflake we had owned through the downturn. We owned it through much of last year in 2025. It's an enterprise software player, database platform. We think with artificial intelligence, one thing that's very important is to have a database platform where you can apply these AI models effectively. So Snowflake is benefiting from that. So that's a stock where we've added to it over the last several months. And that stock, I think, has been up, something like 65, 70% this quarter after reporting inflection point quarters. Okay. So Datadog and Snowflake, what is the commonality there? Well, they're both enterprise software, but it's not like every enterprise software stock went up 50, 60, 70, 100% in the second quarter. That's actually not the case because we have a few other ones in the portfolio, ServiceNow and Microsoft, that didn't go up. But that's kind of part of the healing process, right? And I'll use that phrase a couple of times. We're in a healing process here across certain areas of technology. And with Datadog and Snowflake, what they were able to demonstrate pretty definitively in the first, after reporting first quarter earnings, was that their markets are accelerating. So both Datadog and Snowflake went from effectively 29, 30% growth to 32, 33% growth. So some of you may be listening say, well, it's just, a 3-point increase in revenue growth. That doesn't sound like much. Hey, that's actually pretty rare in enterprise software. When you have a scaled out company doing $5 billion in revenue, I mean, the typical trajectory is for revenue to slowly decline as they get bigger, right? Because you can't sort of grow at the same compound growth at the same rate as you get bigger. Otherwise, you just, kind of grow into infinity. But these companies are accelerating. Why? They're benefiting from AI. So that's sort of one side of it, right? So it's a couple of our enterprise software names. The last point I'll make sort of on software, and we'll probably get back into it, but it's healthy to see not every, what we saw over that 5-month period ending in the end of the first quarter was this indiscriminate selling. Every software stock was down year to date in the first quarter. There might be one or two that were up slightly, right? But everything was down year to date. And most of them were down, 20, 30, 40, 50%. That's probably not a rational response to a technology like AI. There will be certain software companies who are very good at integrating AI into their products, who may benefit from some other AI-driven tailwind. That's what we saw with Snowflake and Datadog, and that's what I think we expect to continue to see in the market is the market starting to recognize that not entire industries are going to be disrupted. There will be winners within those industries. So that was part of it. Right? The other part of it was there are other aspects of the portfolio that I just think were ignored a little bit, whether that was the cloud computing companies like Amazon, who was accelerating growth, almost 30% growth last quarter, and they're in AWS, their cloud computing business. They grew their cloud computing business last year at 20%. So again, a 10-point acceleration driven by AI. Exceptionally strong for a $160 billion revenue business. So that rebounded a little bit. DoorDash, another example of a company that just had no traction. But we get through some of this Iran war conflict, and of course, DoorDash is sort of sensitive to consumer health and energy prices and gasoline prices as a delivery company. So that company rebounded a little bit. We expect some better things there. So again, like when we talked last, we just had a number of areas of the portfolio where it seemed like either the market was outright negative or the market had sort of ignored for a few quarters or for several months. And a number of those areas picked up in the second quarter.
Yeah, that's a great point. And I think you touched on this a little bit, David, but thinking about, fundamentals versus market narratives, I think, one theme that I've heard you talk a lot about is, the distinction between this idea of, changing market narratives and what you're talking about right now, which is, what are the underlying business fundamentals, and we can all sit here and say we know there's a difference, but I think for investors watching headlines every day, can you kind of help explain the difference maybe between, stock prices changing quickly, because that can change quickly, but also this impact of business fundamentals and how that can change, more gradually, but that has a pretty big impact on the price of the companies over time.
Yeah, I think the most important thing for investors and clients to understand is that over long enough periods, share price growth of individual stocks or of the broader index like the S&P 500 will track underlying earnings growth. That is a market truism that happens over time. You can look at any chart over any long enough time period, and that's what happens. Now, what creates the opportunity for an active investment manager like Dana, right? And that is that we do have these moments of panic and we have these moments of greed where share prices over short-term or medium-term periods kind of fluctuate around this fundamental value, right? Think about the underlying business of, say, Microsoft, and they've got an Office 365 business and a Microsoft Azure cloud computing business. Those are core businesses that in aggregate are growing about 20%, a compounded 20% rate currently, and we can probably expect that to continue over the next few years, right? So that business, Microsoft as a company, is getting about 20% bigger every year, right? And it's steady. It's subscription revenue, right? And yet Microsoft's share price in any given period, any given month, quarter, multi-quarter period, can fluctuate wildly around this steady trajectory of revenue and earnings. And we see that with every stock, right? I mean, some share prices are more sort of stable than others, although I would say in this market, and this is probably a more technical discussion, but I think in this market, we're seeing more volatility, even for companies that you wouldn't expect so much volatility, right? So that's an opportunity for an active manager like us. So one of the reasons that you hire somebody like us is to say, hey, Microsoft is growing at a 20% compounded rate. Its valuation is now below the average valuation of the market. The market is growing at 5 to 10%. So we can get a company growing at 2 or 3 times the market rate at a valuation, 18, 19 times earnings, that is below the market valuation. That's the kind of thing you're looking for. You're looking for those dislocations between valuation and growth. And like I was kind of saying a quarter ago, and we still see it today, even with some of the upticks in sort of Snowflake and Datadog and even DoorDash and stocks like that. There's plenty of opportunity left in this portfolio and in this market. And in fact, we even added a little bit to Snowflake after it went up, at post earnings, it went up 60, 70%. It pulled back a little bit and even added a little bit more because we still see 40, 50% upside to our price target for that stock. So we're pretty excited. We remain pretty excited. It's good to get through it's good to get through what feels like the trough, hopefully, knock on wood, of sort of, managing through these dislocations to see a few winners come through. And hopefully we can have a few more winners and kind of get everything working at the same time.
Yeah. Well, to your point, David, about the dislocation, I hear you talking about Microsoft, and it kind of makes me think, Chris, it's like, well, that's a company that you can buy on sale, right? Mm-hmm. It's trading at X, it's worth X. It's trading here, and there's an opportunity there, which I think is a great point to make. But Chris, I'd love to kind of bring you in the conversation too, in terms of, because we've talked a lot about internally, how market narratives can change, much faster than businesses themselves. But as we think about conversations that we're having with our clients, maybe you can speak a little bit about that specifically, and just why the distinction between, price and value is not, always the same thing. And there's opportunity, in some of these markets that have dislocation.
Yeah. Well, and real quick, for the viewers at home, when we hear dislocation, you guys are talking like this fancy word. I mean, we're talking about, valuation, what something's actually worth versus what it's selling for. Yeah. And I mean, that's really what we're talking about. I think a couple things, in that question. One, I think the news and the media cycle run so fast. And as somebody that's been, done national TV and all of that, the one thing is the media is always looking for drama of the day. And because of that, you're going to get some stories that are just coming out simply to drive a narrative ahead, regardless or irregardless of what's going on with that specific that company or those various companies. I think that's why that conversation that we had several months back with you, David, was so helpful, because we had a lot of clients that were nervous. The market wasn't doing great, but it was doing okay, and this portfolio was really dragging down. And your message was, hey, there's opportunity. We're going to find it. Here's the reason we had the pullback. And that was the conversation we had to have with clients. Yeah. Problem is, it's not always a comfortable situation to be in. No one, if we say, hey, there's dislocation right now and we're taking advantage of that, when you're feeling that dislocation, it doesn't feel good. And I think those are the things that we've got to remind our clients about. And that when we're talking about a properly managed portfolio with proper oversight, I love to hear, David, what you're doing. You're sitting there saying even though Snowflake's gone up and Datadog's gone up, when it pulled back a little bit, we still see plenty of opportunity in there, and we're going in. These are the things that a lot of times investors themselves don't have the ability to be on top of. I guess the question that I would really put out there, though, is with that disparity, or to clarify, with this portfolio, we should expect disparity between the general market and this, and that's really because we are talking about some good performing stocks, but those good performing stocks also have greater volatility. And I don't know if there's anything you can comment on that, but I just want people to understand that don't look at this as the S&P 500 replacement. We're talking about a lot more concentration, a lot more focus in certain areas. So when it runs, it's going to potentially run well, but it's also going to have those times that it can pull back, like we saw, as you mentioned, from October and for a several month period.
Yeah, absolutely. I mean, I think you're exactly right. So this is a more concentrated portfolio of 20 stocks, and it's going up against an index that has 500 stocks. And so that index is going to have less volatility relative to a 20 stock portfolio, where we can have a position that's a 8% position or a 10% position or even a 6% position. That is, if it's up or down 30 or 40%, that can make a big difference in the underlying performance of the portfolio. Now, again, I'll get back to the idea that what we're quite confident in for our companies is that the underlying businesses continue to grow at strong rates and at fairly predictable rates. That's what gives us such confidence as portfolio managers to say, let me just sort of level set on the portfolio today a little bit. Okay. So we mentioned Snowflake and Datadog, 30% growers in enterprise software businesses. Enterprise software meaning they're selling to the biggest companies in the world, subscription contracts that have 1 year, 2 year, 3 year contract sort of terms. These are pretty stable businesses that are fairly predictable. Microsoft and ServiceNow, same thing, right? So we've got 4 sort of enterprise software companies that are doing that. Where else do we have exposure? Well, we own the 2 largest digital advertising companies in Google and Meta. What do we know about Google and Meta as businesses? Again, digital advertising is a double-digit growth business, and both Google and Meta are taking share. These are the 2 top players globally. You know who the third player is? We also own it. It's Amazon, right? All the sponsored advertisements in Amazon. Sure. Now, speaking of Amazon, who's the largest e-commerce company in the world? Well, it's Amazon. So we have Amazon there. But what did we add? We added a company in the first quarter that we may have talked a little bit about last quarter, and it wasn't one of our best performers, but we added to it in the second quarter, and that's Shopify. So for every Amazon is where merchants and retailers go as marketplace, to sell on a marketplace. What if you don't want to sell on a marketplace? What if you want your own storefront, your own app, you want more control, you want more control over your brand? What do you use? Well, most people are defaulting to Shopify's e-commerce storefront software, their payment network, and so on and so on. So we have the 2 largest e-commerce players. Shopify is growing 30%, Amazon's growing 10 to 12%. Great. Again, GDP plus growth. The list goes on. Cloud computing. We own the 3 largest cloud computing businesses: Amazon, Microsoft, Google. We don't just own them to own them. They all accelerated their growth in last quarter. In fact, Amazon and Google both accelerated their growth quite significantly. These are $100 billion businesses accelerating. What else do we own in the portfolio? Visa and MasterCard, the 2 largest payment networks. So you can see as we're going down this list of companies, right? You're here. And it's not overly complicated, right? That's why we're so excited about the opportunity today. Because when we say, hey, this is simple. Visa and MasterCard are the 2 largest electronic payment networks in the world. They're benefiting from the shift to digital commerce, e-commerce, value-added services. Oh, by the way, what happens when AI infuses itself into e-commerce and into payment networks? Well, you tend to get more fraud. You have these agents running around doing different things. Get more fraud. What do Visa and MasterCard do? Well, they provide fraud protection services. So that's an additional uplift for them, along with just the underlying growth of digital commerce and e-commerce. Both of those companies, Visa and MasterCard, have not performed in 9 months a year. But again, we may be talking about them at the end of the year in 6 months saying, hey, Visa and MasterCard finally gave us that performance. And the same is true, again, we talked about DoorDash. So now I'm getting to like every name in the portfolio. But I think the point is that, these are leading companies. They're in good industries that are growing quite quickly. And we just have to let them continue. And they have track records of execution. We don't need to, is Amazon going to be able to react to a world of artificial intelligence to incorporate that into their cloud computing business, into their retail business, with Alexa, with making it easier to shop on their platform? Hey, we don't know for sure, but we know that this company's been around for 30 years. And every time a new technology comes along, whether it started with the internet or moved to mobile or it's cloud computing where they became the cloud computing leader, and now with AI, and I hope they're launching satellites in space and things like that. Hey, this is an innovative company with a great culture. I think we have that in spades in the portfolio. And what I like about what we're able to do here is I feel like we don't stretch too much to find the really speculative stuff, right? So we own the 3 cloud computing leaders because they're profitable and they're accelerating. Could we own a startup cloud? There are plenty of those in the market today, whether it's a CoreWeave or a Nebius or something, companies that converted from crypto mining to all of a sudden being AI data center companies. Those might be potentially good stocks, but we don't think we need to go there. We like what we own because we can get Microsoft at 18 times earnings, Amazon at 25 times earnings, Google at 25 times earnings. And we have that stability, that predictability. And we also think we have, most importantly, the quality that we can count on here moving forward. So hopefully that gives you a little bit of a flavor of what we're thinking today.
And just one thing with that, what I like the picture of with this, and what I really love what you're doing in the portfolios, when I look at the S&P 500, everyone seems to know that obviously, we're talking about 500 companies, and you got historically you've got 5 or 10 companies that are killing it. You got 450 companies that might not, and then you got these guys in between. And essentially what you've done is you said, look, we're not only going to focus on the 5 or 10 that are killing it. We're going to focus on those, but we're going to find some of those on the in-between or on some of the other markets. And we're going to build from there, which I love this because if you focus on those 5 or 10, it can be a fire starter, but it's also just super high concentration. And what you all have done is you've said, look, we're going to have that in there, but we're also going to be introducing some other things so we do get diversification and not such high concentration in any one area, but we're getting rid of the 450 other stocks essentially that just aren't going to perform. And I love that because it's that, hearing why you're getting all of these and the intentionality behind it. Mm-hmm. It's one of those things. It's what I talk to my kids about. Yeah. My daughter, she's got a little green light account, and I was teaching her how to invest, and I said, what do you want? And she bought Amazon and she bought Coca-Cola. And I was like, well, why those? And she said, Amazon, because, we use Amazon, and Coca-Cola because they've got all these other drinks in it. It's not just Coke. And she told me all about it. And that's kind of, my daughter's a little bit less kind of in the weeds than you are, David. But again, it's the same concept. It's like, Blythe, that makes total sense. Let's go. And we actually looked at her portfolio yesterday.
She's killing it.
She's doing really well. I'm really proud of her. So perhaps, Jacob, watch out for your job.
Uh-oh, look out. No, David, I was just seconding what Chris says, not about the job thing. But I love when and I think I said this to you last time, David, but, just the reframe, and it's subtle, but you talk about companies, instead of stocks, you specifically say companies. And I think that's so important, to think of it in terms of, we're not just investing in an electronic, share of a company. I mean, we own a piece of this company that we're investing in. And so that, I think that's key. I've got one more quick question and then we'll wrap up, David. One of the points that, I think you've made pretty consistently is that investing, it's not a straight line. And so, periods of volatility, they can be uncomfortable, and, but they've also, and I think this is key, you talk about this, they've also historically, it creates opportunities for us. And so, just for someone who has remained invested through this recent period, could you briefly kind of talk through, and then we'll wrap up, what would you want them to understand about where the portfolio stands today compared to where it stood several months ago? And I know you've touched on this a little bit, but I wanted to make sure we get this question in before we wrap up.
Yeah, and that's why I sort of highlighted that healing process phrase. So,
Yeah.
so when you have a portfolio that goes through a difficult period, a difficult 6 to 9 months, 1 year of performance, and I think last quarter I may have talked about this period reminding me a lot of 2022. So in 2022, we were running the same strategy, same philosophy, and it was the fourth quarter of 2022, we underperformed by about 14%, right? That's very similar actually to the numbers that happened in the first quarter of 2026. But after the fourth quarter of 2022, we started to see a rebound. And I forget exactly what the numbers were in the first quarter of 2023, but it was not probably dissimilar to what you're going to see in the second quarter here of 2026, right? Which is, when you have good companies with fast growing businesses in your portfolio, they can only stay down so long, right? Because the share prices go down, but the businesses keep growing and the disconnect just widens and widens. If you have a 20% down move in your portfolio, but the businesses are growing at 25%, I mean, that gap starts to widen between the underlying earnings growth and the share price very quickly. And so you start to see some companies rebound because, for whatever reason, they report a good quarter or an unexpectedly good quarter, and people start to come back to the story, which we already talked about with some of our big winners. So I think we're in a healing process right now for many of the names in the portfolio. We've already had some good indicators of the approach working, right? Working like it did back in 2023, and hopefully working over, it's a good sign for future quarters. Of course, there's no guarantee that this rebound will continue, and we always have to kind of throw that caveat out there. But when I look at the portfolio today, I think we said 25% revenue growth last quarter for 2026. That's up to 29% today, right? So the companies are accelerating their growth. Just a quarter later, we're at 29%, which is great. Valuation's a little bit higher across the portfolio, but hey, we'll take that trade off. 32 PE versus 29% growth. PEG ratio is still about 1. That's pretty good. Looking across the portfolio today, there are still a lot of companies that have not had their coming out party, which we hope they will. And I mentioned a few of them, whether it's DoorDash and Uber sort of bouncing along the bottom, Visa and MasterCard, same thing, Microsoft and ServiceNow, same thing, and even some of the players like Meta, same thing, right? So we have a good chunk of the portfolio where we haven't had that sort of share price reversion, which we hope to see. But probably what I'm just as excited about is the companies that did have that change in momentum, that change in narrative, so to speak, like the Snowflakes, like the Datadogs. Those companies can have surprisingly strong trajectories in the out quarters. I think I got a question. I don't know if it was last week or something, and they said the question was, what are you going to do with these stocks that have gone up so much, like Datadog and Snowflake? And it's like, well, we're not going to sell these stocks until they reach our price targets. And the price targets right now are still 20, 30, 40% higher for those companies. So those are big positions that we continue to ride. You don't want to sell your winners too early. We always take a fundamental based approach to what we do. So we know where we want to start trimming these stocks and where we will outright sell them because we have price targets. But in the meantime, if you have a 33% grow or a 35% grow in your portfolio, just let that darn thing compound at 35%. And you'll be able to ride the share price up 35% every year, with the value, with the different sort of ups and downs that come with that. So, look, I'm more confident today, headline, that we are through the difficult part of this process. Again, knock on wood, and we will continue to manage the portfolio. You saw us do a few trades this quarter, shifting some exposures around in the semiconductor space, adding a name like AMD, Analog Devices, to the portfolio. We did the same thing last quarter, adding Lam Research, which was actually another stock that was up 100% in the second quarter. So we continue to be active. That's what we do, and we're diversifying the portfolio. And I think we feel pretty good about where we are here. And again, no guarantees, but I think I'm just as excited, if not more excited, than last quarter because we now can show that what we were thinking, what we were doing, there was some credence to it, right? Some of the performance that we've had in the second quarter. And I think that should be exciting for everyone.
Yeah. So David, quick question, because I know some clients are sitting there and they're thinking, when are you putting SpaceX in there? Do you want to? I know compliance is probably going to be like, you can't ask stuff like that, but any 60 seconds perspective on what that would look like. Will it ever enter into this portfolio? Is this the right portfolio for something like that, or is that not something that we'll ever see?
It's possible that we would see it in the portfolio. Now, here's what to give SpaceX credence for what it could be, right? So first of all, Elon, the CEO, Elon Musk, has a track record of building two great businesses, Tesla and now SpaceX, right? Electric vehicles and launch capabilities in space, and satellites and all of that. And now he's saying, we've got our sights set on even more, right? We've got our sights set on AI data centers, both on the ground and in space, and we're going to build a global mobile network, sort of cell network, broadband network. And, those are big markets where if they execute on that, they will do pretty well. And it probably justifies a $2 trillion valuation today or perhaps something higher. But what we also know about the history of Tesla and even SpaceX is that they tend to put out these targets for these big projects, and they tend to miss them more often, right? They get there, but oftentimes it's several years later. So, for example, Starship, their latest largest rocket that's supposed to catalyze the rest of their businesses by being able to launch larger rockets and larger satellites into space and all that, was supposed to be effectively, on sort of operating in 2023, right? It's now looking like 2027 at the earliest, right? And of course, we also know with Tesla, there were proclamations of robo-taxis being around as far back as 2020, and it's 2026, and we're still sort of watching that, right? So I would just say the trade-off that you have to understand with SpaceX is, while it's very rational to bet on Elon as the CEO and bet on the capability that they will develop in these different huge markets, what you have to weigh that against is the time frame for which that will be accomplished. Because 2027 versus 2032 is a very different sort of calculus. It's not much calculus actually, but calculation, gotcha. Right? Because if you're waiting for these different businesses to grow for 5-6 years, well, geez, we know we've just talked about the volatility in the market over a period of 5 months or 6 months. So what can happen to the share price if you're waiting 5 years for something to happen? A lot can happen.
And there's other opportunities that'll pop up in that meantime as well.
So it is the kind of stock that we are paying a lot of attention to for many reasons, and you could see it in the portfolio. We've owned Tesla in this portfolio in the past, and so definitely interested.
All right, sorry, I had to throw that up.
Thanks for the question, Chris. No, that's good. David, thank you for joining us again and for sharing your perspective. Chris, thank you for being here as well, and I think kind of helping us connect, portfolio discussion back to the way we think about, long-term wealth creation and how we build portfolios here at Hobart Wealth. But, one thing that stands out to me from our conversation is that, while markets and narratives, it changes quickly, right? We have to have a disciplined investment process, and that does not change quickly. And so, that's an important reminder, particularly during, periods of volatility. But for those of you invested in our dynamic growth select strategy, we really hope this discussion has provided some additional clarity just around the portfolio, the investment process, and how this strategy continues to fit within a long-term investment plan. As always, if you have questions about your portfolio or how this strategy fits within just the overall financial plan, please don't hesitate to reach out to us. Thank you for joining us, and we'll see you next time on Inside the Portfolio, Hobart Wealth.